My name's Randy O'Toole. I'm the Vice President for the SQA. It's really good to see all of you here. I'm so happy with the turnout, and this is just a fantastic event, so thank you all for coming. I'm up here to introduce our next speaker, who is Dr. Paul Gao. Paul joined the University of Notre Dame in 2007. He's currently the Viola D. Hank Associate Professor of Finance. Previously, he was an Associate Professor of Finance at the Hong Kong University of Science and Technology Business School. He's also been a visiting senior economist at the Shanghai Stock Exchange. Dr. Gao has published in the Journal of Finance, the Review of Financial Studies, and the Journal of Financial Economics. He is the past winner of the prestigious FAMA DFA Prize, the Cowan Memorial Prize, CQA Research Award, and Q Group Research Award. He serves as the Associate Editors for Financial Management and the Pacific Basin Financial Journal. He earned his doctoral degree in financial economics from Kellogg School of Management at Northwestern University in 2007. Everyone, please welcome Dr. Paul Gao.
Ooh. I'm too excited. All right. Okay, thank you for inviting me here. This is my first time to the society to give a talk about what we've been working on. So the format of the talk is going to be a survey of some related papers I worked on, or some of my papers that my colleagues worked on. So it's going to be a synthesis of those things. This is outline. I'm going to start with a couple of examples. And then what I will do is that I will talk about three things. I'll talk about how to use search data to think about stock selection. Then think about how to use search data constructing what I call the investor sentiment index. And finally, how to think about using search data in forecasting fundamentals. So this is going to be three things I'll talk about. So the first thing we'll do here is to show you the power of search data by some sort of very intuitive examples. So this is the first graph. If you go to Google Trend, punch in the word called diet, D-I-E-T, this is how the search volume index will look like. What is search volume index? That's essentially the frequency of search by the users over time. So this is how it looks like. If you look at this graph, what does it tell you? Well, it paints a pretty disappointing picture of our lifestyle. So what's going on is that at the beginning of the year, every year, we crazily search for diet, probably because of New Year resolution or something. And by the end of, let's say, Thanksgiving or Christmas, forget about it, let's do next year. You know, this is not surprising. This is not surprising. But what's really interesting is that sometimes search data tell you something you might not have thought about it. So a couple of years ago, when I was first presenting this picture to my undergrad class, because I thought it's good to talk to my students, see what they think about it. And they point out somewhere, if you look at every year, around April, March or April, there's a spike as well. So I asked them why. Why is the case? What do you think is going on? They give me two reasons. I think they're mutually non-exclusive. The first reason, of course, from a student point of view, is spring break. Or think about is going to Florida for the sunbath. The other one, more realistic, I think what's going on here is that because you're getting into summer, you really desperately want to get into shape. That's why you see right before summer, there's a blip as well. So I think that this picture tells you that if you look at search data carefully, there are a lot of things to be learned from it. And the second one is also interesting. If you search for the word called cranberry, that's how it looks like. Again, this is an interesting case of seasonality. It's like by every time of year until like Thanksgiving or Christmas, you see search volume increases. Otherwise, people pretty much forget about it. So I think these two examples about the power of the search data. But the question here is that how are we able to use search data in finance in particular? So that's where we're going to go to next 3 topics. Starting with think about the search data, investor attention, and stock selection. So that's going to be the first one. So a traditional asset pricing model made a very strong assumption. The assumption here is that the information is incorporated prices instantaneously. So essentially, the underlying assumption is that everybody behaves like a supercomputer. You get all the information processed right away, and you get access to all the information, and it's build the prices. But what's going on here is that information needs to be to track investor attention first before it can be really processed and translated into actions. And it turns out that that's precisely the psychologists were thinking about as what we call limited attention. So it's important to make assumption here is we need to think about is not all the information gets equal weight. Some attracts our attention, some are not. So the limited investor attention is often associated with slow information diffusion or underreaction to news. This is interesting because this tells us or gives us a framework to think about how to use this idea in practice. So if you want to think about an event-driven strategy, think about take advantage of some sort of slow information diffusion, that's where you need to think about. Whereas we have not paid enough attention to it. So I think that's where the starting point is. If you think about attention, the attention here, you can think of 2 types of attentions. The first type is retail investor attention, like a non-professional investor. Probably does not apply to most of us here. On the other hand, there is so-called institutional investor attention. That's mostly applied to the ladies and gentlemen in this room. So it turns out that even though both of them talk about attention, it turns out that their attention are different. So what's the fundamental differences? For the retail investors, they're less likely to immediately react to the information when it arrives. That will almost imply a delayed reaction and delayed overreaction, and consequently imply return reversal in the future. On the other hand, for the institutional investor, they are likely to pay attention immediately, and their impact on the prices is going to be most likely permanent. So there's going to be a difference between these 2 types of investor when they're thinking about their attentions. But in measuring attention, if you want to put into practice, it's actually difficult. So, or tricky in some cases. So what are the examples we have thought about so far? So for example, we have thought about trading volume. We have thought about extreme returns. We have thought about advertisement expenses. We thought about news. We thought about day of the week. So for example, the day of the week here is that maybe we are more likely to pay attention to things if it is not Friday, when everybody want to go home. If it is Monday, perhaps we'll pay more attention to it. So these are people thinking about, but sometimes it's not precise. So for example, if you look at the news is really, there's hundreds of news articles published about hundreds of firms on a daily basis in the journal, but how many really articles attract attention? So it's really a supply or passive way of thinking about information, not precisely what we think about as being, we pay attention to it. So how to measure attention? The simplest way is to put a chip in everybody's brain, but obviously we can't do that. So what we're doing here is that a couple of years ago, in a paper, what we're proposing is to use Google search volume. What's going on here is that the search volume can be thought of as a measure of attention. Because when you search for things, you're definitely pay attention to it. So that's where we think about using search volume as a measure of attention. And furthermore, at that time, the data were available to us was Google Trends. And if you think about the users of Google, who are most likely are going to be non-professionals. If you're a professional, we know we're searching for things or even book our airline ticket from the terminal, not from the Google search engine. So we think the search volume recorded by Google is going to be a very good measure of retail investor attention. So that's where's our starting point. And let me give you a couple of examples to show you that how we're using this data in finance. The first example we showed you here is think about the search volume of companies' name around IPOs. As you understand here is that IPO, before IPO, there's no trading volume, at least in the US market. There's no trading volume. There's most likely the media coverage is relatively limited. The analyst coverage is none or very limited, so on and so forth, right? So it's very hard to think about how to measure attention because like extreme return, like trading volume doesn't work here. But if you look at how many times people searching for the name of the company, that's going to give you an indication whether the retail investor clientele will pay attention to it or not. So what you see here is that tells you the mean and the median search volume, standardized, normalized over the IPO window. So week 0 is the week of IPO. -1 is 1 week before IPO. +1 is 1 week after IPO. So what you see here is that as time approached IPO, at the week of IPO, the search volume is highest, then actually tempered off. So what you see here is interesting because it tells you that in terms of tension, actually really the IPO is like the day or the week, went out with a bang. Even though we know IPO itself increases the recognition over time. But it's this tension per se wise, it's like really just a temporary thing. So why do we look at this graph? Because we can think about this graph and think about the valuation of the IPOs. So if you think about IPOs, there are 2 salient features with typical US IPOs. The first feature is that usually on average, the first day has very high return. That's a pop. And then less sort of more debatable, or at least most people agree, is that on the long term, IPO underperform. So the question here is that what drives or unifying this idea of the first day high price and long-term performance? So we think actually the uninformed investor may actually play a role. So what's going on here is that maybe what's going on here is that first day high price, and it's part of it, is because the retail investor getting too excited and push up the close price too high. And consequently, over long term, as the interest dissipated, the move back to fundamental, you have the long run underperformance. Can we test this idea? So what we did here is that we actually think about doing this. So for a set of IPOs, we look at, essentially what happens is that we look at the pre-IPO search volume. Those with very high search volume or those with relatively low search volume. And then look at the first day returns. What we find here is that the half of the IPO that has very high search volume, it turns out that the average return is about 17% mean, versus those with low search volume, it's only about 10% or 11%. Of course, in our analysis, we control for many other differences, and these differences still remain statistically and economically significant. So the first part of the hypothesis here is that, well, it looks like a retail uninformed demand was pushing up at least part of the first day high price. And how about the second hypothesis? Because that will imply over long term, there's going to be return reversal, right? Do we actually see that? So what we did here is that among those IPOs with the highest return, first day return, let's break them into 2 parts. Those with high versus with low pre-IPO search volume. So what you find here is a sharp contrast. Those extremely high search volume exposed earns negative return or slightly negative return, depends on mean or median you're looking at. In contrast, if you look at the ones with high first return, But low pre-IPO search volume, it turns out that there's long-term, there's no underperformance. Actually, there's slight outperformance. I think the interesting story here is that if you think about those with high search volume were demanded by uninformed investor who push up the price. So therefore, the first day price too high, and consequently, long-term underperform. Those were not, probably the price about right. So this is an example to show you that actually, in the context of IPO pricing, which you can't really find a very easy way to think about retail investor attention, these simple metrics tends to be useful. You can generate this idea to a sample of Russell 3000 stocks. So what happens here is that you look at the week when they have high search volume, the week afterward, so on and so forth, until like a year later. So what you'll see here is that 1 week or second week, when you observe the surge in search volume, the prices increases. And then consequently depreciate over time and almost revert back to its fundamental by the end of the first year. This is consistent with the following idea. The idea here is that when there's some seasonal events triggered or stimulates retail investor attention, they start to purchase. And remember, these people essentially were purchasing for no reason, very young informed. And then temporarily push up the price. If you believe the short-term, the supply and demand curve of these stocks. And then what happens here is that over time, the price pressure because of this purchase dissipate, and the price reverted back to fundamental. That's sort of what essentially this picture was telling us. Remember, this results, it's not really that strong. It's not, you can't directly really make money out of it if you think about the transaction cost. But I think what's interesting here is that, first of all, it tells a consistent story with what we observe in a relatively small sample. Second, as we shall see later, is that I think we should not think of data or big data or any kind of data as being sort of like a silver bullet solving every problem. What I think is important here is that use this information as sort of an indirect way of making inferences and enhance the strategy returns. And instead of saying, okay, here's the data, we're going to solve every problem. Because it's just going to be one factor in your whole decision process. That's what I learned over a lot of these exercises, which I will show you later on as well. So far, these first two examples, that the source of search data is really the Google, like a retail investor search data, right? But in economics, where you hit most is that it depends. So I'm going to show you that actually if you switch your source of data from the retail search data to institutional search data, your results are going to be different. So all of you ladies and gentlemen know this better than I do. So on Bloomberg, actually there's something called, I think it's called, it has its own sort of like what I call search data. So essentially what's going on here is that Bloomberg are used by financial institutions. And it generates sort of user-generated data. So if you read an article, you assign a score to this particular firm. You mention the article. If you search for a ticker, Bloomberg will count as 10 for that particular firm you're searching for. So based on this user-generated or user-contributed content, they come up with some sort of attention measure by the users on the terminal. And then what they do is that they report this data on a rolling basis through a day. And based on transformation, which I outlined in the slides, you can think about on a daily basis, you know which company has attracted a lot of institutional investor interest in terms of viewing, in terms of searching, so on and so forth. And let's call this, for simplicity, abnormal institutional attention. So the construction detail is different from how the Google constructs search volume index. but the idea is the same. So I think that as long as we know this point, then we're good. And what happens here is that keep in mind, when we interpret this data, even though they're all search data, you have to think about the economics. They're different. The economics here is that, remember, institutional investor, they process information most likely immediately, and they're likely to have permanent price impact. That's sort of the premise I have. And as a consequence of this, the more, or think about it, it's like the article read by more and more people, that means that the information in general diffuses faster. If the article read by very few or searched by very few people, then that means that the information probably diffuses relatively slowly. And that idea will help us to think about how to construct portfolio trying to exploit underreaction to news. So I'll give you two examples to show that even though we're not using the data itself to make any directional bet, but it can help us to think about enhancing returns of this news-driven strategy. So the first news-driven strategy everybody is very familiar here is this earning momentum strategy, or academic like to call this earning announcement premium strategy. So the idea here is that you buy the guys or girls with a high earning announcement surprise, and short sell the ones with negative surprise. Over years, this strategy has been working, but attenuates over time. So the question now here is that how you can be able to do this, enhance its returns. So it turns out you can use the abnormal institutional attention measure generated by Bloomberg. So essentially think about you first classify a portfolio into two parts, those with high or those with low institutional attention. Then within each portfolio, you further sort on the earnings signal you got. So it turns out that the earning momentum is much stronger when the abnormal institutional attention is low, and it's going to be much higher. It's much higher when the institutional attention is low. Because why? Because not everyone underreact to the news. On the other hand, if the abnormal institutional attention is very high, it turns out that the earnings momentum strategy just doesn't work very well. And the last line of this table shows you that over a 5-day or 10-day window, the difference can be as much as 60 to 90 basis points without any kind of other sort of enhancement, just based on whether there is kind of abnormal institutional attention, which is the data available readily from Bloomberg. And in addition to the earning momentum strategy, you can also think about so-called analyst forecast drift strategy, right? You're basically buying with the analyst direction and short selling when there's a downgrade, when the buy there's upgrade. It turns out that there's underreaction to the recommendation changes. So it turns out that, again, if you do this kind of strategy, when the institutional investor attention is very low, it's much more profitable. If the attention is very high, it turns out it's almost zero. And again, these two generate statistically significant returns. So in these two examples, what I showed you here is that we're not really sort of directly using this abnormal institutional attention to make directional bets, but instead, we're using it as a supporting criteria, thinking about how to enhance some of the returns we believe were generated by underreactions. So I think that's a way to use the data. And of course, you can think about this also give you an interpretation whether there's crowded trades. So for example, but this is just isomorphical to see whether there's profit or not, perhaps to some more extreme extent. So these are two examples showing that yes, you can use data in some, I think, useful way. The first couple of examples shows you how to do stock selection in the IPO, Russell, and early momentum, analyst forecast momentum strategy using search data. The second part of my talk is going to be about how to use search data to construct investor sentiment index. So in the first part, we talk about individual stocks. But now we're going to talk about a bundle of stocks in a market portfolio. And it turns out that we can also use search volume to think about investor sentiment and think about the market level, technical, short-term asset allocation. And so the theoretical, the background of the theory here essentially is that if you think about price variation, it comes from two parts or combination of things, which as academic we actually believe the both. Come from both the change in fundamentals plus the change in investor biases. Biases, or you can think about it like some of the behavioral biases we may think about here, or maybe some of the instructional frictions we're talking about. So, but I'm just saying very general terms. So the crucial question here is that would investor sentiment affect these stock prices systematically through this second channel in particular? I think the theory answer is like a noise trader model or limited arbitrage, these kind of things. We are familiar with, so I don't want to get into it. But the real tricky part is how you can measure investor sentiment. And everybody has its own favorite sentiment. You may like a VIX better. You may like trading volume, or you may like some sort of moving average. I don't debate that. That may be working, maybe not working. Everybody has its own favorite details, right? But the point here is that I think if you think about constructing of investor sentiment index or measure it, the difficulty comes from, it's difficult to measure. Lots of times we use financial market outcome, like trading volume or VIX. But do they really just reflect a fundamental or reflect sentiment or both? It's hard to say. And sometimes we think of them as being relatively low frequency. For example, Michigan survey, I think it's monthly. And even Michigan survey covers, I think it's like several thousand households. It's not really that representative. I don't know. I think that we want even bigger sampling. Of course, a bigger sampling always involves higher cost. Who's going to pay for that? And also is that it also, if you think about this kind of sentiment index, most time we talk about in the US. And it's very hard to do this actually in many other countries. And some other countries have other preferred sentiment index. But usually we don't have a uniform set of index we can work with. So what happens here is that we propose in a paper published a couple of years ago to use search volume of Google to measure wide spectrum of market, its investor sentiment. That was really motivated by several observations. So this is a search volume index of this keyword called recession over time. I updated this graph yesterday, but what you see here is that perhaps not surprisingly, we still remember vividly the recession in 2008 and 9, right? And similarly, if you look at the keyword search for bankruptcy, this is how it looks like. And this is a keyword search for unemployment insurance. This is how it looks like. This is a keyword search for unemployment. This is how it looks like. Why do I show you these four pictures? What we had in mind here is that can we find at least words which are economically motivated that reflects what you worry about? If you don't go to the internet and start to search for unemployment insurance, if you are not worried about your job, you're not going to the website, at least in a systematic manner, searching for bankruptcy. If you are not worried about your personal financial status. So the point here is that can we come up with a list of words that reflect people's sort of worries or concerns about their financial stress? So that's the starting point of our exercise. But we don't want to do this. We don't want to do this in an arbitrary way because as a lot of speakers prior to my speech already sort of mentioned about here is that if you don't have a discipline, you may overfeed things, right? you may actually generate a bunch of things which is in-sample describes things very well, but out-sample doesn't work that well. So we want sort of a guided or disciplined search for this kind of words. How did we do it? So we started with Harvard Dictionary. So there's like a linguistics, there's a dictionary published by Harvard, for example, tells you that each word is an economic word or not. Whether this word has a positive or negative intonation. So our idea here is let's go to the most frequently used English words. Let's find all the words that are both economic words and has some sort of sentiment to it. Because some words just don't have sentiment to it. We want the word both are economic and sentimental in that way. So that's essentially the starting point we have. It turns out bankruptcy, recession, unemployment, they're all economic words and negative sentiment words in the dictionary, which is very intuitive, right? But it turns out the dictionary has many more other words. It's actually, there are several, there are almost like several tons. It's like 40 or 50 words. So how do we actually deal with it? Well, I will show you. And this is a word. This is another example to show you that the search volume, so this word, recession versus Michigan survey, we normalized at the quarterly frequency. And of course, remember, if you are more negative, you search more for recession. But for Michigan survey, the higher the value, the better. So we negate the search volume when we take a log to make it inside the same as the Michigan survey. I mean, it's just a simple case. It doesn't really mean that much, but at least give you some hope. There's some use to it. Okay, now let me show you exactly how we did it. So what happens is that, remember, I said from the Harvard Dictionary, we got all the words which are economic words, and there are also sentiment words, right? So then what we did here is that we look at something called related word search based on Google. Essentially, that's sort of like related to, Brian was talking about it as n-gram. So here we just use bigram. So essentially like a gold price. So gold price will be a related word search. So we figure out all this related word search, and then what do we do next? We have to do selection. So which words are most important to think about in our construction of this index? So to be objective, what we did here is that we look back in 6 months window and see whether that word is associated with return or not, but only using historical data, not using current data. Only if the word and the return exhibit some sort of statistical significance, then we just retain it. At the end, in the end of the day, we may have 30 or 40 words, and we just take a simple average of it. And that's our sentiment index. Well, this sounds very simple and straightforward. Actually, it turns out that it's actually very powerful. And here's the example to show you that some of these keywords we use in the full sample. But of course, in our analytics, in the published paper, we do this on a rolling basis. So there's no forward-looking biases. We are keenly aware of that. And so why this is useful? It turns out that this sentiment index constructed based on historical returns, based on historical return and the search volume relationship, that index has very strong usage of power in the future. Essentially, whenever on day T there's a price or there's a market return decreases, the sentiment actually decreases. But if the sentiment decreases too much, it turns out that tomorrow there's a reversal. So it's a very good contrary indicator for the return next day or two. And you can do this not just for S&P 500, which I think is very large portfolio, which is there is little transaction cost. You can do this at VIX level. You can do this at both VIX futures. You can do this at S&P realized volatility, which means you can do this at swap trades, so on and so forth. Not just return, but also volatility. So high sentiment, low sentiment today, high volatility. But will predict reversal of the volatility in the future. You can do this at a different style portfolio, and the result is even more impressive. If you look at these hard-to-value stock or hard-to-arbitrage stock, that's not probably going to be implementable. But it shows you the point that actually the hard-to-value channel or limit-to-arbitrage channel work with the sentiment. You can do this, for example, with fund flows. So what you see here is that it's the high sentiment states. What you see here is there's inflow of equity fund, but low sentiment states there's outflow of equity fund, and the vice versa with a lag for the fixed income flows. So it's also related to the equity flows. So essentially, this is evidence what we have on a daily basis using index for the U.S. But can you do this outside the U.S. on a global basis? Because after all, we want two things. First is that we want a larger sample, because if you have a global portfolio, it's much easier to work with. Second one is that it's more valuable to have some sort of sentiment index, especially high frequency, on a global basis. So essentially, we did the same thing, and for other countries. Thankfully, because Google is quite popular in many countries. This is a breakdown of their market shares. Even in China, the market share is about 25%, which is considered as the lowest market share among all the countries Google were in presence. And but when you deal with foreign languages, things are slightly trickier. So we actually have to. This was implemented. This group of people have to think about us for translations, do the verifications, so on and so forth. But eventually, what they did here is that they look at this kind of related words, and then think about putting related words into two categories. One, those related to economics and finance, like what we did before, and those related to something not related to finance and economics, but related to some sentiment events, like what they call disaster, war, sports, holidays, terrorism, pollution, so on and so forth. So this approach, what you do for non-US, outside the US, this set of two states are going to be slightly different. But with this modification, what you see here is that essentially you can construct index with two types of sentiment words. One are related to economics and finance. One's related to sports, related to holidays, related to terrorism, related to pollution. Those are not directly related to economics and finance. And then you can take an average of these two across different countries, and you find your own country-specific sentiment index. So in their work, what they find here, for example, this is the sentiment index for US and Italy for a period between June 2004 and December 2014. I'm not very familiar with Italy. I'm not sure whether this graph is exactly true, but I think the contrast is dramatic. So how do you use this kind of data in finance? Well, so I can do two things. I'll show you two things. The first one is about this dual list shares. As you know here, these are the situations the shares essentially share the same kind of cash flow rights, but they're traded at different locations. And think about it, it's a Japanese firm, Japanese market price versus New York price. And of course, they're all denominated in US dollar, but except that one price is formulated in Japan, another one is in the US. So in theory, these two prices should be the same. If you ignore potentially difference in voting rights and those kind of things. It turns out they're not. They're sort of systematically deviate from this one-to-one relationship. What drives the deviation? It turns out other people believe sentiment. So this graph essentially shows you that when the foreign country sentiment is stronger relative to US sentiment, the foreign share price is higher, and vice versa. So this essentially tells you, by looking at these two sentiment index, tells you that where deviation of these two this share will likely come from, or the change of it will likely come from. The other case is you can do country, very short-term technical asset allocation at weekly frequency. So think about it, in this case is like we have 38 countries. We constructed this country-specific weekly investor sentiment, like I just described to you before. And then what happens here is that, first of all, not every country, but 20 out of 38 countries, this sentiment can predict future returns as a contrarian predictor at a 5% level or higher. So there are about 18 countries I count predict with precision with 5% level. However, from as a location point of view, it turns out is that you can always buy the countries with negative sentiment this week and short the countries with positive sentiment next week. And then your return is about 11% without a transaction cost consideration. And the Sharpe ratio is about 2.0. It's not that impressive, but I think it illustrates that the sentiment seems to have some useful for very short-term, weekly or monthly technical asset allocation. And again, our purpose is to illustrate that sentiment is useful, but we're not really optimized to do anything about it. And finally, before the end of my talk, I want to talk about very briefly that you can use search data in the fundamental research as well. And I think by this point, it's not surprising anymore that search data has value. So let me give you one example. This is quarterly sales value for Garmin, and the search volume for Garmin. And this is revenue for Chunky E. Cheese. And everybody laughs. When I mention about Chunky E. Cheese, everybody laughs. And this is sales volume plus the search volume for Chunky E. Cheese. I want to emphasize what you see here is that there is strong correlation. A lot of it driven by seasonality. So in the paper, which I do not want to get into detail today, you can go to my website and you find it. It turns out if you do a rigorous regression analysis, you are able to find that the search volume, or more precisely, optimal search volume does predict the earning. And the earning announcement period returns, at least in the sample period we studied. So I think that even from a fundamental point of view, if you're not dealing with stock selection or technical asset allocation, even for a very fundamental analyst looking into the search volume, can still deliver something. So thank you for your attention. Yeah, you have questions, just feel free to ask, please. I'll try to answer what I can.
Hi, very, very interesting presentation, thank you. There's a previous literature on sentiment indicators that I wanted to touch on, for example, Baker and Wörgler. Could you talk a little bit about where you fit in with that? So for example, how do you correlate with that? How do you correlate with that in particular periods? For example, in page 36, where you show the Italian versus US graph, I see that the US sentiment doesn't deteriorate in 2008, whereas theirs does. Do you have any comments there? Or maybe some of their words. So one of the constituents there is the number of IPOs that they use. Do you see the word IPO, for example, in searches? Thank you.
I think the Baker and Wörgler sentiment index is very useful. So what's going on here is that essentially, they look at a set of equilibrium outcome. So for example, you said about the trading volume, said about IPO first day return, number of IPOs, so on and so forth. And they take a principal analysis of these individual components and put an index. My personal take is that these kind of index, Baker and Wörgler index, describes the variation of sentiment from one year to another, or one quarter to another very well. Because by design, they're not designed to think about the sentiment variation from 1 week or 1 day to another. So I think that they're serving for different purposes. Baker and Wörgler is more like over long-term, low frequency sentiment, how they're moving. And as you can understand here is that here we're, by definition, we're looking at high frequency sentiment, right? From one day to another, or from one week to another. So I think that because you're in different domain, it's very hard to say which one is used for or not. I think there are several different purposes. Yeah, that's my view. Yeah.
Your slide 36, which compares Italy with the U.S. sentiment doesn't decline in 2008 during the financial crisis.
This is accumulative.
But wouldn't, maybe I misunderstand, I would expect it to reduce?
Yeah, this is U.S. sentiment. This is cumulative U.S. sentiment, 2008, 2009.
Okay.
Yeah, I think that's. I'm not saying that I'm exactly getting the timing right. Actually, if you look at the recession, the recession data on the Google search data is actually more accurate than this one. But you know what we did essentially is that we can't just rely on one observation to see this. We have to come up with a methodology. Sometimes even miss something. Yeah, that's what.
Just a quick question. Do you think there would be any difference if you were to aggregate that data with perhaps, let's say, the second most popular search engine, if you were like Bing? Is there any consideration in that? What are your thoughts on what, if any, changes there would be to that addition?
I think it might be useful. I'm not sure how much Bing and the Google, the overlap in terms of what sort of the fundamental difference of the clienteles. I never worked with Bing data, so I'm not able to comment on that. But as academic, we always find the more data, the better off we are. So the real answer is I don't know. I think there might be some things to it. So for example, like in China, I know Bing presence, market presence is definitely more than Google. But both of them are lag behind Baidu. So I think that it really depends on where you are searching for things. Yeah.
As research like this becomes more popular, what do you think about attempts to manipulate the search data, right? So you can imagine that as a trader, you know, to aid your algorithm, you know, you may send out some automatic searches to influence some search results so that people trade in a different way. Any thoughts on that?
Essentially, it's about data auditing. It's like every data has some sort of what I call the intentional or unintentional pitfalls, right? So even at the end of the day, you have to be skeptical of where you get into it and how much information content there. And I think what helps is that you always think about from a finance point of view, is that we always think about there's a theory behind. Like, I don't know how many of our nuclear physicists, but here's a story I really like. I want to talk about it. I read it somewhere. I think it may be helpful to think about this data. So I think the story is that there was a debate about neutrino travel faster or the same speed or slower than light, right? I think that's sort of the debate. And there were some scientists at CERS that find that, wow, neutrinos seem to travel faster. And then upon announcement of this finding, preliminary finding, there were three kinds of people. The first group of people come and say, you know what? It cannot be. This is just inconsistent with my prior. Let's repeat the experiment again, and find out whether the case or not. The second group comes and say, you know what? That's fantastic. Let's rewrite the whole theory again so that we can fit the new empirical regularity. I like this third group the best. What they did is that they said, oh, you know what? This is really interesting observation. Given the theory we have so far, given the empirical observation we have so far, can we derive some alternative implication and then test whether we find it or not? It turns out that the empirical observation made first was wrong because there was some wiring problem. But I think the lesson, even though it's not in our field, I think the lesson here is that, just as you said, the data could be wrong. The theory could be wrong. So we need to combine data and theory and say, you know what, can we come with alternative kind of ideas to test and then reinforce this kind of idea? So I think that I do not directly answer a question about whether if the Google data is manipulated, how we're going to deal with it. But I think at the philosophical level, I gave a solution for it. That's what I think.
Thank you, Professor Gao. Very interesting research. I have a question on your last slides where you're using search volume data to predict revenues for companies. Just the fact that I'm searching for a ticker or a company doesn't necessarily mean I'm bullish or bearish, right? So
the search volume is for the major product. So therefore, I could have been more precise. So what happens here is that in the example I showed you, I'm focusing on the firms that from Nielsen Media data. I know that they're major product names. So what happens is that this is actually a very painful exercise. So from Nielsen Media, we got all their advertisement associated with the brand names. And then we focus on a set of firms where you have only one or two key product. And then instead of searching for company ticker sample, we're searching for these key product names. And then we write the paper for it. So it's slightly different from what we did before. We're searching for the ticker sample or some short form of company names. Yeah, I could have been more precise. Yeah, thank you. Okay.
Yeah, so just following up on that question, does the reliability of that search data for predicting revenues, is that higher for more retail style products and products with, or companies also with, say a higher number of unit sales relative to, something that, a company that might sell B2B and, one large or two large transactions per quarter?
Mostly consumer product.
Okay.
Consumer staples. And this results actually is much stronger in the first half of the sample than the second half of the sample. I'm very skeptical you can still get much out of it by now, because I think that even my students in the class, when they write the equity report, they look at a search volume. But the point here is that I think eventually I want to show you that even for fundamental forecast, search data can be useful. I mean, we can't say just because my student was using it, then you should not use it, right? Because we know the Stiglitz paradox. If you don't use it, it'll show up again. It's almost like a treadmill. You have to keep dragging on it. Yeah, that's information. You know that for any information like this.